Welcome back. We're halfway into Chapter 8, Section 5. We're going to talk about annuities, saving, investments. All those things go together. The most important thing is to start early and start smart. Here are some of the objectives we're going to try to accomplish. Finding the value of an annuity. Right off the bat, get a pencil and paper, pause this if you need to, because you need to write down some formulas. You're going to be able to use these on any test or quiz you're going to have, so have those and have those available for your use. Also, determine what those regular annuity payments should be if you've got a goal in mind. A little bit about what are stocks and bonds as investments, a little bit on reading stock tables, and finally, understanding some of the accounts designed for retirement savings. Number 1 on the list, annuities. It's a sequence of equal payments made at equal time periods. So, for example, at the beginning of this month, you might put away $100 or even $5, anything, and continue to do that at equal time periods until the annuity actually matures. The value is the sum of all deposits and the money you put in plus all the interest that's accrued in the meantime. Here's an example we can use to follow. You deposit $100 so that, $1,000 into a savings plan. Quite a bit of difference, isn't it? And that's the amount that you're going to do regularly, and you're going to do it at the end of every year. And you're going to do it for 3 years just as an experiment. The bank or whomever you are working with says they'll give you 8% per year, compounded annually. So we're going to make it as simple as possible. You want to, number 1, you want to find the value of the annuity after the 3 years, and also find the interest that you've gotten in the meantime. So look at the bottom here. Remember, you're putting $1,000 in the annuity at the end of each year. So at the end of the first year, you haven't put anything in yet, but you put the first $1,000 in. At the end of the second year, you've had $1,000 in for that entire second year, so it's gained some interest. And this is the formula for simple interest. And then you put another $1,000 in because it's the end of the year again. So at the end of the second year, you have $2,080 after putting $2,000 in. What about the third year? Okay, you've already got $2,080 in. It's gaining interest. That's what this part is for. And you're going to put your usual $1,000 in at the end of the year. What do you have at the end of 3 years? $3,246.40. So the value of the annuity is at $32,46.40. You made 3 payments, each of $1,000. So you deposited a total of $3,000, but the annuity itself is worth now $3,246.40. The difference is the interest. That's how much you've gained at that 8%. Here's the formula you need for annuities. So grab this formula, put it somewhere important. Right here, A is the value of the annuity at a certain point in time. This is how much you're putting in on a regular basis. It's not all the principal you're putting in, it's how much you're putting in on a regular basis. In the previous example, it was $1,000 at the end of every year. The R, of course, stands for annual rate. T is the time in years. Make sure if anything is in months or something else, convert it to years. This is just a -1, and this rate goes in that formula twice. There's your value of the annuity formula. So here's an example. Example number 2. You're going to invest $1,000 into an IRA. Great idea. You're going to do it at the end of every year. And you're going to do it for 30 years. And you've found a deal where you can get 10% per year. And it's compounded annually. It's not simple interest. It's compounded annually. So the first question is, how much will you have from the IRA after 30 years? Well, that's that formula I just told you you needed to write down. So write that down if you haven't already. Put it back for a second so you can write it down. Pause, write it down, and then continue. Okay, you're going to do that for 30 years. You're going to find what the amount is, and then after you find that, you're going to find the interest. You can't get the interest directly. You're going to have to find the amount or the value of the annuity first. Subtract what the total is for all your payments. So you'll take this, subtract all your payments, and that'll be the interest. So this is how it goes. Here's your basic formula. Here are the numbers put in. This is your regular amount invested. This is the rate, which goes in here twice. This is the 30 years. And after that, just put your calculator to work. I dare you to actually put this into your calculator at one time. Can you do that? I dare you. You could do it in pieces. You could add those together, take it to the 30th power, subtract 1, and so on and so on and so on. Or, if you know how to use your calculator properly, you can put it all in at once, hit enter, and you've got the result. Now, what can you do to figure out if you've got some kind of reasonable answer? Well, that's sort of tricky with annuities, because after 30 years, you're going to get quite a bit of interest. You know, of course, 30 years, you're going to be putting in $30,000, so it's going to be more than $30,000. But you might be surprised how much it is. In fact, take a look. $164,000 plus. You only put in $30,000 total. That's pretty amazing. That's the power of starting early and being regular with your payments. So here we go. This is what we got for the final value of the annuity. This is how much we actually put in regular payments, and this is how much you got back in interest. Notice it's almost 4.5 times the amount of payments, and that's just the interest. So here's your formula, expanded just a little bit. This is if it's compounded several times a year. Notice a couple of changes. Now the previous one you might actually want to get rid of. This is the formula you really want to keep. Almost all of this is the same. Here's the final amount of the annuity. This is the regular payment you're going to make for 30 years or whatever. This is the annual rate. The difference is this N here and here and here. Those N's represent how many times your annuity is being compounded every year. Of course, this is the -1 out here. And this T is in years. Make sure you've got it in years. So here's an example for us to look at. So you're 25 years old, and you decide you're going to deposit $200, just $200 into an IRA at the end of each month. You've got an interest rate at 7.5% per year, compounded monthly. How much will you have when you retire at 65, assuming you retire at 65, and then the interest? But you have to get this first. You can't get the interest directly. You have to get the amount, the annuity amount first. So here's how you do it. There's our formula. Here's the regular payment amount. This is our annual rate. This is how many times it's compounded per year. And that shows up 3 places. The rate shows up 2 places. There's a 1, it's not an L. Put those in. Again, I challenge you to do all of this at once in your calculator. Now remember, you're putting only $200 in at the end of every month. Look at what you ended up with at the age 65. Oh my gosh, that's over $500,000 in your IRA. And if you don't retire at 65, it continues to grow. How about the interest? Well, this is what the value of your annuity is. And this is how much you actually put into your annuity. $200, 12 times a year, 40 years. $96,000 is what you put in. And you got out $604,765. This is how much you got in interest. Notice that you got 5 times the amount of your contributions because, number 1, you put money in regularly, and 2, because you started early. Next. Oops, something happened to this one. We'll see it again. This is the formula, in better shape, of course, that you need if you're going to figure out, okay, I want this amount of money at age 65. What does my regular payment have to be so I end up with that amount? See if we've got we've got the formula coming up here. So here's an example. You complete your college education, begin working, and you'd like to save $20,000 over 5 years so you can make a down payment on a home. Lots of people would like to do that. And 5 years isn't unreasonable to wait. So you're going to make regular end-of-the-month deposits in an annuity that pays 6% and it's compounded monthly. How much do you need to deposit each month so you end up with that $20,000 with which you can make a down payment on a house? And then second of all, how much of that comes from deposits and how much of it comes from the interest? Well, it's only 5 years, so the difference isn't going to be huge, but you might be surprised. So here's the formula that we didn't see earlier. So write this one down. This one gives you the amount for your regular monthly payments. Now, it's just monthly because this and this and this are 12s. If you made them more often, then that number would be larger. Put all those appropriate numbers in. This is what you want for your down payment. This is your interest rate. This is how often it's compounded per year. And there's your 5 years. Put that all in, and what you find out is that if you put $287 aside at the end of each month for 5 years, you'll have that down payment on a home. $20,000 worth of down payment. So you got that $20,000, this is how much you had to put aside in payments over those 5 years. Now, if you subtract that from the $20,000 you ended up with, that's how much interest you got over the 5 years. Now, what are some of these things? Putting money into a bank account is making a cash investment. The interest rate guarantees a certain amount because you're putting it into a bank account. It's covered by the FDIC. What you get on your investment is called a return. Now, that's not the only way to make investments. You can also put some money in stocks or bonds, but they are riskier. This one is pretty much guaranteed from the bank because the government's behind that. On the other hand, stocks and bonds, if you make a good investment and if the risks don't drag you down, you can make some serious extra money. So what are the stocks? If you get stock, you're actually purchasing stock, which are shares of ownership in a company. So, for example, a company issued 1 million shares of stocks. And one investor, maybe you, bought 20,000 of those shares. So the investor, by getting 20,000 of those million, owns 2% of the company. Notice this, do the division, get a decimal, change the decimal to a percent. So the investor owns part of the company, and they're called a shareholder. If you decide you're going to buy it or sell it, that's called trading. That's talking about the stocks. They're traded on a stock exchange, not necessarily the one up north, but at the stock exchange somewhere. There's two ways you can make money. If you sell shares for more than you paid for them, that's called a capital gain. That's a gain on, but you only have it when you sell the stock, assuming you gain. While you own the stock, typically a good company distributes some of the profits to the shareholders. Those are called dividends. So at the end of every year or fiscal year, when they have their profits determined, they'll send the stockholders some money. Now, how about the bonds? Well, some companies sell bonds. This amounts to lending money to the company, and they're worth a certain amount of face value. And you get the face value along with interest payments at a certain given rate. If you have a number of investments, put all those investments together, that's called your financial portfolio. A very smart idea is to get different kinds of investments. That's called a diversified portfolio, some with higher risks than others. Now, what do you see on the in the stock tables? Some of the things you see are the 52-week high. That's the highest price for the previous 52 weeks or year, not calendar year, just the past 52 weeks. You've got the 52-week low. Those are next to each other on the stock table. The stock refers to the company name, and the symbol refers to the shortened version of the company name. DIV is talking about the dividends paid per share. So it depends, The dividend depends on how many shares you've got. Yield stands for percent of yield. Volume 100 stands for sales volume in hundreds. That's because this number can get rather large. So they put it in hundreds so the number can be a little bit smaller. So when you look at this, if you want the actual sales volume, you need to multiply it by 100 to get the final answer. High, that's the highest price yesterday. Low, lowest price yesterday. Why yesterday? Because we don't know what the high is for today or the low is for today. It's always about yesterday. Closed, well, it's not today because we haven't closed the stock market yet. What it represents is the price of that stock when it closed yesterday. So all these refer to yesterday. Net change is how did it go up or down from one day to the next. Now here's where I lose contact with what they're talking about. You would need to talk with someone that knows economics or is really in the finances. This is the price to earnings ratio. I've heard of it, but I don't totally understand it. It's yesterday's closing price, that's yesterday, divided by the annual earnings per share. And of course, the annual earnings per share, the bigger that is, the better your stock is. And this is comparing those two. So here's something you can try. We'll use the stock table for Disney for a particular time. I don't know when it was, it doesn't say. But it's an exercise. We're going to find the high and low prices. If you own 3,000 shares, what dividend would you have gotten? How about the annual return for dividends alone, and so on. So here's our listing for Disney. I'm going to have that on each of these slides, so don't worry about needing to write it down. So first of all, A, the high and the low. Well, it's right here at the beginning. 52-week high, good. And this represents the 52-week low. It doesn't say 52-week, but it is. So you've got 22.50 was the low, and the high was 42.38. You can see those right here. Next, we want to look under the dividend part. Well, the dividends say 0.21, that's 21 cents, and that's per share of that particular stock, Disney stock in this case. So if you had 3,000 shares, you'd have 3,000 times the 0.21 that you see up here, and you would get a dividend of $630. Of course, the more shares you own, the greater the dividends. The yield is the percentage that give investors an annual return on their dividends. For Disney, it's 0.6%, shown right here. Vol 100s, remember, this has to be multiplied by 100 to actually get the dollar value. High and low prices, you can look for under high and low. That's for yesterday. And this is how it closed yesterday. And then this last one, when the stock exchange closed yesterday, how was it compared to the previous day? Now, remember, we're not talking about today. We're talking about yesterday and the day before. Did it go up or did it go down? In this case, since there are just 3 dots, it didn't go up or down from the day before yesterday to yesterday. And to get the price to earnings ratio, just put these numbers in. There's yesterday's closing price. there's price to earnings ratio, and there's your average earnings per share. Okay, we're getting close to the end. We've got two more things to talk about, two more quick things. An IRA, you've heard of IRAs, I'm sure. One thing you ought to know is that, of course, it's for retirement. You don't touch it. Set aside money, and that money you deposit in the IRA is not taxed. Withdrawals are taxed. That's why you want to leave it in. As soon as you take it out, you get taxed on it. And of course, there's a certain percentage that you get per year on it. And so you want to get a good IRA with as high a percentage as you can. Currently, or according to this slide, you can start withdrawing from the IRA when you're 59.5 years old. Now remember, I said the IRA, the traditional IRA, you don't pay taxes on until you take it out. And contrast that with the Roth IRA. This one's different in that you pay taxes on it first, put the money in, and then when you get it out, it's already been taxed, so it never gets taxed again. So it's a trade-off. Do you want it taxed first, or do you want it taxed later? And last of all, one good thing about having a nice employer is sometimes they'll set aside money for you in 401k plans. These are used as incentives to get the best employees possible. Well, that's it, folks. That's all I know about annuities and various investments. Good luck. Start early and be regular with your deposits. Well, keep smiling. I'll see you soon.